One of the biggest money-making skills you can learn in trading is how to do the range trading correctly. And I see a lot of people doing it wrong, so in this video I'm gonna explain to you how to do it the right way. So today's topic of the video is gonna be how to identify the range, how to trade it, how to position inside of the range, and step-by-step guide. Yes, that's me. I have helped dozens of traders for the past 5 years. I have a private network, I have a free newsletter, I do one-on-one sessions. These are my stats, everything is verified. All the links are in the bio. You want to learn more about me, just go and check them out. If you enjoyed the video, leave a like, subscribe and comment. So, how to identify a range? We first identify a range by recognizing both the range high and low, and this will most often follow a strong impulse, move or expansion. We're looking for price that consolidates between two range boundaries following an expansive move, and with this we're able to derive direction and high probability setups. And on each chart this animation of price can look a bit different, even though the context behind and the concept remains the same. This is the way how a range looks like. On Bitcoin, that's just a quick example. So you have the range high, you have the range low. So this is the way we identify. We identify the range low, we identify the range high. You can take either the close on the 4 hour or you can take the high. It depends. I prefer to take the close. Pretty much on Bitcoin on the 4 hour, it's very, very well respected. Sometimes better than the high itself. That's why I prefer to use it. And in this example, low, high, pretty much front run of the low. You backtest the high, mid, partial rise, SFP of the equal lows, move up to the high, SFP of the equal highs, mid, high, mid, high, almost touches the mid. Another example, low, high, and very similar thing as you can see. Front run at the bottom, SFP of that front run. Here you have a partial rise, you tap the mid. And when trading a range, we can expect particular moves and components, more specifically range deviations, and in simple terms we expect the range high to be deviated in addition to the range low, meaning we can look to trade price deviation. So this is the way deviations looks like. So here you have a deviation, then you show momentum to the downside, you change the context. Over here, later on the video I'm going to explain to you what do I mean by changing the context. Then you do a sweep of these lows. This provides us with specific components, specific take profit targets and a clear framework. So pretty much here you can see mid, bottom, mid, partial decline, breakup. I'm gonna get into details later on. Let's look more specifically at deviations first of all. This is where price moves above or below the range boundary, and moving through the low of the range is a range low deviation, and moving through the range high is a range high deviation. So expecting a deviation from a range, this could be the range high or the range low first, and this is always the first rule. A deviation must be presented. Once price moves from the range boundary, we must assure that it is indeed a deviation, because sometimes you can get a move outside of the range boundary and it can be a breakout. You have 4 steps. Range high, range low is formed. We observe price ranging between the two boundaries. You must wait for deviation and reclaim and trade the deviation to the opposing direction. This is the way it looks. So this is an example with previous day arrays on BTC, and when expecting deviations we can look at the PD arrays as a point of interest, and we're expecting price to react from that and once it leaves the range boundary. And this is of course the place where we can expect a reversal from price. The best deviations move straight into the FFG before reclaiming the range boundary. So below or above the range where we expect deviation to take place, we must also consider previous day arrays such as FFGs, order blocks, breakers and more, and you will also yield better results if the deviation clear engineered liquidity. So in this place, engineered liquidity. Also looking into the order flow in exo charts, we could clearly see down here we had a bunch of shorts opening, here we had a bunch of longs opening. So this is the way it looks. Now getting into more details, there's 3 techniques which I like to use. So you can pause this, you can read this out, so I'm gonna get into it a bit shorter than you can see. So the first technique is gonna be drawn liquidity, and when trading ranges you must consider the higher time frame price action in addition to the range itself, and we must be looking to take a position in the direction of the draw of liquidity. And pretty much these are smooth edges defined as equal highs, equal lows. Awesome. Liquidity, equal lows. Another variable which we'll look at regarding the deviations is liquidity, as the chance of the deviation reclaiming the range and moving to deviate of the opposing side is much higher in the event that it is cleaned a significant liquidity. You have a liquidity, you have stops, they get cleaned. This can be observed as equal highs, equal lows, as I showed in the previous examples right here. So here you had equal highs, sweep, deviation. Equal lows, sweep, deviation. And in terms of entry, once price has deviated, a bias has been developed, and we're simply looking for entry functions and confirmations, such as intraday shifts or breakers. Entry trigger, this is an example. So pretty much this schematic is very clean. This is Altcoin or RD. I just saw it look for the perfect example. So over here, what you can see up here in terms of you have the high, you have the low clearly. You do a swing failure pattern at the high, you clear the liquidity, then you change the market search, you back test the golden pocket, and you move back down. And over here you did back test the golden pocket as well. So in this example, I'm gonna repeat myself once again, this is a schematic. You need to change the market structure, you need to have a clear draw on liquidity, and you need to back test a point of interest. In this terms, this was the golden pocket, and I do expect similar thing to happen in this place as well, where you do sweep this liquidity. Here you have this equal low, so you can see you sweep that out, you kind of change the market structure, so you can expect back test into this golden pocket and then move up. This is simply a range. Now the step-by-step guide is very clear. Identify the range high, identify the range low, range deviation, and entry function. It is such a simple strategy, guys, which is so underrated, and people make it so so complicated and complicate things without any need to do that. You can take things simple as that. Thank you for staying until the end. If you like this video, subscribe, comment. All the info is in the description of the video. So see you guys later.